it's Jeremy Reeve. We're gonna tell you how to make some easy money today. Because all you gotta do is when a stock goes down, you just buy the stock. That's it. It's that easy. And today, we're gonna talk about PayPal with SNAYSAL. Welcome back to Strongman Personal Finance, everybody. My name is Christopher Belly. I'm a certified CPA accountant. I'm a long-term bobblehead investor. I'm author of the book Stop Being a Broke Loser. It's on Amazon. Go buy it so I can get rich. And today, we're going to look at PayPal stock. That's right. So I'm on vacation right now. I'm in somebody else's office. I can't disclose whose. But before long, I'm going to be on the road. And then I'm only going to have my cell phone. So I'm trying to pump out as many stock videos as possible. Now, PayPal has recently been all flutter on YouTube, okay? Because it got annihilated based on earnings and revenue projections. And we're going to see if the stock's actually a buy. Because one of my favorite YouTubers of all time, the person that I listen to most, Jeremy Financial Education, is saying it's easy money. Easy money, bro. So let's go look at PayPal by SNAYSAL now. PayPal by SNAYSAL. Okay, so first let's read this article. PayPal reported mixed Q4 2021 earnings and provided guidance for the next quarter that fell short of analyst estimates. See, what happens is these companies have forward guidance that isn't as good as expected. They can get freaking wrecked, which is what happened at PayPal by SNAYSAL now. So, revenue, blah, 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 blah. PayPal forecasts revenue to grow about 15 to 17% for the full year of 2022. That's a good indicator of what you can use in your analysis, or you can even go lower if you want to be conservative, okay? Analysts expected year-over-year growth of 17.9. So because their forward guidance was 17, and analysts expected basically 18, the stock fell 17%. That's kind of extreme, but we'll see what the numbers say. And slower user growth, really. So PayPal, which has a ton of competition and is a more mature company, has slower user growth. I cannot believe my eyes. Okay, so what we're going to do, we're going to use some simple inputs, some simple data, and we're going to put this into my ghetto model that I made at work in 20 minutes, which I'm sure Jeremy knows how to. I'm sure this is what Jeremy does for his analysis. And we're going to see what a good price is to buy PayPal to get a 10% return and a 15% return. Now, keep in mind, I would not use this as a buying metric. This is a way to screen out stocks. And if you want to actually buy PayPal, you need to do more research and really consider its moat and the competition. Because I think there's a lot of freaking competition with PayPal. I mean, what did I do? I sent a Cash App yesterday. I sent an Apple Pay yesterday. I've used Venmo. I've used all sorts of crap, okay? So PayPal's not the only payment processor in town. So let's go ahead and look at some metrics. So here's my tool, and we're going to use this tool to put it together. So the first thing we need is trailing 12-month revenue of PayPal. So you go on the internet. This stupid Apple actually works. I struggle with these things so much. Jesus, come on. Come on, there we go. So first we're going to look at trailing 12-month revenue, which I like to call trailing 12-month revenue. So PayPal had $25.371 billion of revenue over the last 12 months. 27. I've already forgotten the numbers. Oh, Jesus, man, I would never buy a Mac. 25.371. 25.371. 0, 0, 0, 0, 0, 0. Oh my God, it's a buy at 32. No, we have to put more numbers in. Next, we need the shares outstanding because we can determine our discounted earnings per share by taking the net income, the discounted net income each year, and dividing it by the number of shares outstanding. So let's go look. Will this actually work this time? Nope, of course. I have to keep going back like this. Shares outstanding? How many shares stand outstanding, bro? Now it looks like, holy crap, looks like they're buying shares back. That's nice. I'm actually going to try and put in my model share buybacks. I don't know if it's going to malfunction it or not. we'll see. So currently they have 1.186 billion shares outstanding. 1,186, comma 000, comma 000. Okay. Discount rate. This is the rate. This is the profit you want over the next 5 years. The lower you buy the company, generally the better your profits are, of course, because you're paying less for future earnings. Revenue growth. So PayPal's forward guidance was 15 to 17%. But I like to be conservative. I like to not take as much risk. So I'm going to say, let's go with 12%, because maybe over the next year it'll grow 15%, maybe. But if you look at it over the next 5 years, growth is going to slow. It's not going to keep growing 15, 15, 15, 15. I would say 12 is a good average. But if you want to be more specific, you can actually plug in the numbers there. It's all based on your assumptions, ladies and gentlemen. 12% revenue growth. Profit margin. Let's see what PayPal, my SNAYSAL's profit margin is. Come on. There we go. Okay, margins. Margin by margin. I like margin. It sucks going forever. Trailing 12-month margin. So we look at PayPal's normal profit margins, and it seems like before the pandemic, it was very, very, very predictable. They were getting roughly between 12 and 14% bottom line profit. And then the pandemic sent it freaking everywhere. So it looks like it peaked at 22%, and now it's going back down. I think 12.5% would be a good profit margin to use. Just looking at these numbers, and you also want to consider there's more competition. So the more the competition, the less the margins are, because there's competition. Duh. So let's be safe and let's use 12% profit margin. Okay. PE at disposition. This is always the tough one. You can really change the value of a company with this PE at disposition, because basically this model assumes you buy the company, you hold it for 5 years, and then you sell the company. And the majority of your cash flow coming in is you selling the stock or selling the company. So, I mean, you could use 20. Okay, see this number down here, buy price. If you put in 20, the buy price goes up. If you put in 15, the buy price goes down. If you think the PE is going to be 1, it goes down even more. So we'll be nice to Jeremy and we'll say 20. Okay. Now let's see what we got here. So revenue should be correct. Shares outstanding are correct. Discount rate 15%. Revenue growth 12. Profit margin 12. PE 20. Now, according to this model, okay, PayPal stock, in my opinion, for a 15% rate of return, this is just a screener, is in the 50s, $56. What's it trading at right now? Oh, it actually worked that time. Nice. It actually worked that time. Oh my God, let's do this. PayPal stock. So it's currently trading at 86. So let's see the performance over the last 5 years. So you see we had this massive freaking run up. And of course it started during the pandemic. Just like a Tesla. And it ran up massively. And then it got freaking wrecked. And now it's down in the freaking tubes. Okay. I personally probably would not buy the stock where it's at now. So you see the PE ratio is 24. Okay. Because it's more growthy. I mean, usually the average of the market is 15. But if you think about it, in 5 years' time, 15 would potentially be reasonable for PayPal. But we use 20 in the model just to be nice to Jeremy Lofufu. Because, I mean, that kind of makes 5 years from now, 15, 20, that makes sense. Now, what if you wanted a 10% rate of return? $69. Now, let's see what the actual, I think the rate of return would be if you bought it now. Oh, is that 86? Perfect. So I think if you bought PayPal right now, assuming these numbers are correct, you would get a 5% rate of return. That's hot garbage. I'm not going to get a freaking 5% rate of return. Now, Jeremy, in all his wisdom, what he does is he said, the stock went up and then it went down. So because it went down, it's a buy. Not necessarily. It is cheaper, but I don't think it's a buy. And if you look at where the stock was trading, 300. Oh my God. Yeah, you would not get a positive rate of return if the stock was $300. That's just insane. Okay. Now Jeremy was buying it at around 120. So let's see what I think his rate of return would be. Oh, cancel, cancel. Okay. Let's try 2%, 1%, 0%. Shit. I don't even know what he would probably. He's probably still going to get a negative rate of return. I wonder if this is going to malfunction my model. Let's see. Oh, -5%. Let's see. So -4, -2. So I think, according to this model, Jeremy's rate of return for buying it at around 120, and maybe he bought it at a higher price, is going to be -2%. Okay, so let's go back, and I'm going to give you my honest opinion on when I would buy this stock. So 15%. And see how hard this is, ladies and gentlemen? This is just, it's so easy to screen out these. Oh my God. If you want 1,500% return, you buy it at 19 cents, 15%. Okay. Revenue growth 12, profit margin 12, PE disposition 20. I would buy this in the 50s, being perfectly honest. And this is with conservative assumptions. If you want to be even safer, you want to say 10% revenue growth, still in the 50s. So low to mid 50s is when I would seriously consider looking at this stock to get a 15% rate of return. So a lesson is, number one, Jeremy's an idiot. Number two, it isn't necessarily safe to buy a stock, even if it's dipped massively. Let's see if the buyback thing doesn't malfunction my model. -2%. Should go higher. -4%. Okay. Let's see if they're doing buybacks. Let's do PayPal share growth year over year. Are they doing buybacks? Are they doing buybacks? Let's see. Maybe this data will have it here. Shares outstanding. Where'd it go? I just had it. Let's go back. There we go. So shares outstanding. It looks like they've been buying back roughly at a rate of, they issued some and they bought some back. We'll be nice to Jeremy. We'll say -2%. Okay. So even then, we'll do 12% revenue growth. Even then, okay, maybe I would consider buying it in the low 60s, assuming they start buying back shares. But even then, it's not even near the price I would want to pay for it now. It's ridiculous. So PayPal right now, it's cheaper, duh, but it's not a buy. And I think Jeremy's going to get a roughly -2% return going forward. What a freaking moron. So that's my thoughts on PayPal. I don't really think they have a moat. Like I said, I've used Venmo, I use Cash App, I use all sorts of crap, and it's all the same thing. And PayPal, man, their fees piss me off. You know how I know they have fees? Me, Kevin paid me $300, and I only got $289. And I was pissed, boy. So that's my thoughts on PayPal. But you may think my assumptions are ridiculous, and I don't really care. But I'm not going to buy an individual stock unless I really think I'm going to make money on it. Mike Stathis likes Aria DCF. I need to put a blonde-haired, blue-eyed baby in my model. Buy Tesla, you'll be rich. Absolutely. Maybe I should do Tesla. Maybe I'll do it later. I got some work to do today. But Lafufu told me to buy it. Yeah, I mean, it went down, bro. When it goes down, just buy it, bro. It doesn't matter. It's obviously cheap if it goes down. I bought July 2017, and then I bought more recently at 120s. My average is 81. Yeah, I mean, that's not horrible. You're going to get some kind of positive return, I think. But it's not going to be this mind-blowing return. I mean, of course, I could be wrong. If PayPal's revenue blows it out of the water and they keep their profit margins higher, okay, maybe you can make money. But if you want to be really conservative and safe, probably in the 50s. Not funny today. Buy VT, max your tax advantage accounts. Can you also do course series? I did do it. I made a video on it. Trust me, I made it. Go check it out. Me, Kevin, bought you for cheap. Oh, he's going to be paying way more for me. See this expert analysis? Wouldn't you pay a lot of money for this? I need to start charging for this. You people are getting everything for free. Bunch of moochers. I love your ideas. You are brilliant and cool. I wouldn't say I'm brilliant. I'm just very conservative. I'm not going to buy an individual stock unless I think I can make a lot of money. So, just put in some really conservative assumptions. And if it meets that buy point, if PayPal dropped to 50, sure, maybe I'll put $1,000 into it and I'll just wait for 5 years. I'm patient. Even if it dips lower, I don't care. I never thought once to buy above 120s. Yeah. I don't know exactly when Jeremy bought it, but we all know he's an idiot. And I even heard maybe he bought it in the 150s. Oh, God. Did you do a video on your analysis for me, Kevin, on Adobe, wasn't it? Yeah, I might actually do an introductory Adobe analysis today, and then I'll do a more in-depth one for my step row later. MSCA. What is that? Isn't that the index, the global index? I agree with your analysis. Thank you, everybody. You see how hard this is? You make a little crappy model, you put some numbers into it, and you play out a bunch of different scenarios, and you give a rough buy point, and then you just keep it in your mind, and when the stock goes down low, you buy it. Oh, so hard, bro. It's so hard. Just like Baba. All you make fun of me, but I still think it's cheap. Do you believe in stock picking if you are decent at it? I don't know if I'm decent at stock picking, to be perfectly honest. The first time I bought individual stocks was March 2020, like all the other clowns. Before that, I just bought index funds. So I haven't invested long enough to know. Now, if China recovers massively and I make a ton of money, okay, maybe I am good at stock picking, but I'm still not gonna put a massive part of my portfolio in individual stocks, because at the end of the day, you may think you're a genius, but you turn out not to be. Haha, is that a Jeremy hat? Yes, it is. I'm actually going to take it home with me. All right, that's it. Maybe I'll do a quick Adobe Nairobi analysis, and then I'll be on the road. So it's only cell phone videos for the next couple of days.